I've been trading for 14 years, but it wasn't until the last 3 that I finally cracked the code, making $4.5 million and breaking the world record with a $2.5 million payout. In this video, you'll discover the easiest way to trade ICT from scratch. Exactly what I did to turn 10 years of losses into massive profits. I was unprofitable for way too long, jumping between strategies and blowing accounts, but the simple ICT approach changed everything. First, here's the easiest place to start with ICT. So after 10 years of struggling with every strategy you can imagine, I made the biggest mistake most ICT traders make. I tried to use every concept all at once. Order blocks, breakers, market structure shifts, and I was drowning in analysis paralysis. And that's when I learned that the most important lesson of my trading career was that simplicity wins. So fair value gaps are easy to spot, but somehow a lot of traders still use them completely wrong. And let me explain. So let's first talk about what exactly is a fair value gap if you guys don't already know. So simple, the definition is that we have the empty space created when a price makes a sudden move, leaving an imbalance. And why is this important is because opportunity to make money in the markets occur when price is out of balance. So what does that actually look like in a chart? When I stripped everything away and just focused on 2 things, all right, fair value gaps are price imbalances where price moves too fast. And once I focused on this, my win rate went from roughly 30% to about 70%. So these imbalances are created from a 3 candle pattern. So what we have is a candle 1. So for a buy side imbalance, as the market is trading higher, right, we have this second candle that creates a large range. And then that third candle doesn't come back to fill in the body of candle number 2. Okay, you guys can see here the highs printed here, and then it doesn't actually trade all the way back down. If it were to trade all the way back down there, then we don't have a gap in price. Okay, and vice versa for sell side imbalances, as the market's trading lower, this shift in price, right, is showing you that there's a sell side imbalance. So sellers are really overcoming anything in the market, right? They're eating up all the bids that are in here, and it's just completely dumping, and it's creating a gap. So we have a gap from this low to this high. Okay, and this will only occur after candle 3 closes. Okay, so we don't have a fair value gap until this third candle closes. So if you guys are seeing price action right now and you're looking at this, right, the fair value gap does not get created until this candle closes. And likewise, it doesn't get created as long as this candle is still going. So when this candle closes, then we get the fair value gap. Okay, so what we're looking for is a rebalance. And now what does this actually mean? When price expands very quickly, oftentimes, and the way that I like to think about this is that institutions, they can't get their orders filled at a specific price. So if they are trying to fill a lot of their buy orders, maybe it's causing the market to jump higher, right? They have so much volume. Maybe they're taking billions of dollars in a position, right? And it's causing the market to jump because there's not enough liquidity. And the way that the markets work, if you guys don't know this, is that if there isn't enough orders on the book to fill at a specific price, the market will move until that order gets filled. And that's what creates these imbalances. So what happens is, right, if you guys understand what that level 2 is, if there isn't enough orders, let's say there's like 1 order, 2 orders up here, maybe there's 3 orders up here, but I placed 7 orders, well, it's going to just keep going up until all 7 of my orders are filled. If there's not enough orders at one specific price, it's going to keep going higher until I get filled on all of them. And that's what creates slippage. Okay, so that means I'm not going to get filled all at one price. If I market into the position, I'm not going to get filled all at that one price. So essentially, when we have that imbalance, okay, that's what I'm looking for. We have an imbalance, and I'm looking to see if the market will retrace, fill in more of the orders that were left behind. That way I can position myself long as the market's trading lower into the fair value gap, and then expecting it to go higher. And vice versa, if I'm expecting the market to go lower, I want to see it trade higher into this sell sign imbalance, pick up those sell orders, and then trade lower afterwards. So let's go through just a couple examples of the fair value gap. So here we do have a fair value gap here. You guys can see this one right here. And as it's trading into it, I typically will not enter as it's going into that level. Sometimes I will. It depends on the price action, depends on what time I'm sitting down in front of my charts. But usually the best time to enter is when it's going into that fair value gap. Okay, so I entered long here. You guys can see here, I have 2 contracts on Euro futures. Now, the market doesn't matter. These fair value gaps work on any market. You guys should go and study each one individually and just kind of pick an asset that you like the movement of, that you're very comfortable trading. Okay, this lower level down here is our 4-hour fair value gap. So you guys can see here that after we got that bounce, I entered long here and then exited here. So that's the exact reaction that we're looking for. Now, the hard part, right, is sitting in all of this, right? So when I enter the market, many traders think that the market needs to go directly to their take profit, in a straight line. And this is not, they're not comfortable sitting in this. As soon as I enter the trade, I don't know what the market is going to do. I don't know if it's going to go sideways like this, right? It got halfway into my stop loss, but I've traded these setups enough where I'm not going to panic. I'm just going to let the trade run and then try and manage it if it goes in my direction. Okay, if it gets close and close to my stop loss, I tend not to do anything. Okay, I've already accepted the risk that I put on in the trade, and I can't control whether the market's going to go sideways on me or not. All right, this market could have completely just gone sideways for a very long time, maybe even to the next day before it actually got the run that I was looking for. Here we have another example. Right, we have this nice fair value gap here. Same thing here, right? We were getting all these drives lower, so we can see all the wicks from these 4-hour candles trading lower into the fair value gap. I'm going long after the rejection, okay? I could go long as it's trading into that fair value gap, maybe put my stop loss below the low of the fair value gap. But typically I like to use swing points. And if I were to enter here, my stop loss would need to be all the way down here, okay? On the lower time frame, you guys can see that this is our hourly. Right, so even on the hourly, we still have that fair value gap. This is the same, if you guys can see, it's on the 23rd. I just don't have this 4-hour fair value gap showing here for whatever reason. But you guys can see here that we do have another 1-hour fair value gap that's inside of that structure. But I was looking at this here. So entering long, you guys can see I went long 3 contracts and just exiting after holding this trade for quite some time. Okay, so oftentimes when I'm planning trades, because I'm trading futures and I can't hold them overnight on a lot of my prop firm accounts, I'm just exiting based on time. Sometimes I'm getting 1R, sometimes I'm getting 2R, sometimes I'm getting 3R. But when I'm planning out 3R, very rarely will I be able to hold that trade overnight unless I get a really tight stop loss. So you guys can see here, I was able to scale into the trade. So as soon as I entered it, it went against me, right? And this is, again, part of the mental battle of learning how to trade is when you enter a trade, I can't control if the market's going to go in my favor or not. I have to be comfortable with the risk that I put on. Okay, my stop loss is down here. This is my invalidation. I'm okay if the market goes down there because I'm going to let the market take me out. I'm not going to prematurely take myself out of the market. That's the reason I have a stop loss, okay? And if I were to exit emotionally, I wouldn't have gotten the win, right? Very, very important that you guys study this and that you guys get comfortable with risk because when that P&L is fluctuating, you're going to make stupid mistakes that's going to hinder your performance, okay, for the long term. One last example here. I will note, so this is not just about fair value gaps. It's very important that you have these fair value gaps marked out, but when we invert those fair value gaps, we can also use these going in the opposite direction. So there is a failure rate with these fair value gaps. They don't always work. And if I were to go back to these examples, right, if this fair value gap failed, let's say if this fair value gap failed and I got stopped out, on the way down, I would look to position myself short because now the order flow is changing. Okay, if this is a buy side imbalance, there really shouldn't be any reason for us to close below that and then invert it. But if it does, it's giving me the opportunity to reposition myself going the opposite direction and taking advantage of that opportunity. So you need to understand the hit rate of these fair value gap setups. They don't always work. Okay, if you can get really good at them, they might work 40 to 60% of the time. As with any trading strategy out there, it's very, very difficult to start pushing those high win rate numbers unless you're trading a negative risk reward scenario or you're very, very disciplined with the trades that you take, with the trades that you're filtering out. So here we have that inverted fair value gap after the rejection. Okay, so even though this market traded up in this fair value gap and then dumped lower one more time, maybe you guys caught that short after trading into that level. And let's say if you did take profit down here and then all of a sudden by the end of that 4-hour closure, you get a closure above the fair value gap here. Well, this is signaling that there's a change in the state of delivery because why would the market close above this fair value gap if it was a bearish imbalance? That is a major tip off that maybe we're going to go towards this buy side liquidity here. Yeah, so you guys can see here I planned a trade where I have this inverted fair value gap. My stop is all the way at the low end of it and I'm targeting the buy side liquidity all the way up there. All right, you guys can see here I was able to scale into this trade as well. So I had 5 contracts, added another 2 as we broke structure here and then continued higher and then exited here ahead of that buy side liquidity. Now, you know everything there is to know about fair value gaps, but this is only part of ICT analysis. So in order to tie this into a consistent strategy, we need to isolate ourselves and get a sample size. So why is, for me, isolation so important? I was only able to become a profitable trader when I cut out all the noise of online. And when you are just coming up in trading, it's so important to really filter out who you want to listen to and who you don't want to. But when you're just getting into trading, you're trying to pick apart every everybody's brain. You're trying to follow 50 different traders online. You're trying to watch 6 different live streams all at once to try and get all this information. And what it really leads to is a silver spoon in your mouth. So you're looking for those trade signals. You're looking for that person's analysis. You're looking for them to go streaming live so you have somewhat of an idea of information when it comes to trading. But the only way that I was able to progress as a trader and become fully independent was isolating myself and not caring about what everybody else was doing. You are never going to learn and be an independent trader if you can't do that. So why do I bring this up? Is because I was in ICT's mentorship, and when he didn't post the weekly analysis, I was completely lost throughout the week. I had no idea what I was doing. I was taking trades that I probably shouldn't have been taking. I was basically just lost, right? Running around, trying to find any piece of information to generate my bias, to generate my trade ideas. And I was looking for outside things instead of learning how to become an independent thinker. And that's the whole point of trading. So isolating yourself, stop listening to other people, stop trying to learn so much all at once, and just learn a couple things like I talked to you about with the fair value gaps. Learn the fair value gap and then sit down and actually do some homework. So this is extremely important for you guys to do, is actually get a sample size of data enough that you're going to become confident in this setup. So I'm going to only bring this up because one of my students actually did this, and I have all my students do this. I have them go back and back test, and I have them do homework assignments, and I actually want to talk you guys through this. So he actually did the homework assignment a while ago. This is August 6th, 2025. So this was posted 2 days ago, actually. So the setup is as follows: high time frame buys based on weekly, daily order flow with a potential of market structure shift. We're not worried about the market structure shift. Once that was identified, I filtered through the PA, simply looking for an hourly fair value gap in favor of my bias. That is a major key. In favor of your bias. So if I'm bullish, I'm only looking for bullish fair value gaps. Okay, so write that down. If I'm bullish on the week, I am only looking for bullish fair value gaps. If a bearish fair value gap appears, I typically won't trade it. Once the fair value gap was confirmed, I was in my normal trading time window. I marked it in. Okay, so a few qualifiers. I used a large account size just to get a feel for what it would be like. So ignore the profit numbers. All right, this is a really good result, better than what I'm seeing live, although I believe it was a legitimate sample because I stuck with the losses. That is a very, very key factor. Sticking with the losses and understanding that you are going to have losses. Okay, you are going to lose a lot of your trades. I don't care how good that fair value gap looks. We are not out here just punting our entire accounts on the next fair value gap because it will always have a failure rate. There's always another side of the coin. Even if you have a 70, 80% win rate, there's always a 10, 20, 30% chance that you're going to lose the trade. Okay, get comfortable with that. Okay, so he's saying, I agree with JCap on the limited benefit of backtesting because it's so easy to spin through time. That's what I'm talking about. Spinning through time and actually sitting in the trade is something that not a lot of people understand. Sitting in that trade, you're going to have tons and tons of emotions that pop up while you're in the trade as that trade is fluctuating around. How do you deal with that? What are the decisions that you're going to make that's going to keep you on track in order to hold that trade towards your target? Okay, plan your trade, trade your plan. Now I'm going to go over his results just from this fair value gap homework assignment. Okay, right, you guys can see that he has very, very big losses, but his wins are outsized. So he's risking about 25k per trade. It's a very large account, mind you, right? He might be trading $1 million, $2 million. Looks like he's trading a $2 million account. So that's assuming, maybe he wants to trade a $2 million personal account, or maybe he's assuming he wants to trade $2 million in funded capital, but he's risking $25,000 per trade. But you guys can see here that some of his wins are very, very big. So he's got $45,000, $41,000, $37,000, $177,000, 18. This one is a little bit small on the smaller end. $62,000, $67,000, $81,000, $221. So even just one of these wins, right? Like this one here for $177,000. Think about this. How many of those $25,000 trades is he gonna have to lose in a row before he gives back this? That is proper risk reward, and that is accepting the risk. Okay, he's taking these losses on the chin and then following the plan. Whereas most traders, they take losses like this, they're gonna, their plan goes out the window, right? When they get kicked in the teeth, plan goes right out the window. See this? Trade win percentage, 63%. That means he's losing on 7 out of 12 trades. He lost 7 out of 12 trades, but he still ended up with $632,000 in profit. Yes, this is a demo count, but don't look at the numbers, okay? Look at the profit factor. Look at the average win to average loss. It's almost 3R. Do this on any size account. It doesn't matter if it's a $2 million account or a $1,000 account. This is the type of performance you're chasing as a trader. And when you can get this performance, now it's all a game of capital. That's all it is. You get this performance, you stay disciplined to this process, you do not change it, okay? And you scale this. So the biggest problem with traders is that once they get something that works, right? You're trading $100 risk. You think you're getting really good performance at $100 risk. Now, all of a sudden, what happens is you want to size up, okay? So you start risking $200 on the next trade. Now, all of a sudden, your brain goes, hold on a second, I'm risking more money. I need to learn more things to help manage this position better. That's not what you should be doing as a trader. What you should be doing as a trader is accepting that you've already learned enough. You already have an edge and putting size behind it and being comfortable with this. This is all you need. A simple fair value gap setup with context and proper risk management. And you'll get results like these. Once you have results like these, you do not need to learn anything else. Okay, it's just about leveling up as far as size. Because each time you go from $100 risk to $200 risk to $400 risk to $600 risk, what happens is those emotional challenges get bigger. And that's where your mental capital should be going, not I need to learn more concepts to help manage this risk. That's not what you should be doing. The best thing that's going to help you manage the risk is sharpening your mental. That's all it is. Once you have a profitable strategy, you scale it infinitely. Okay, so simplicity scales. If it works on a $1,000 account, it will likely work on a $10,000 account. It will likely work on a $1 million account. It's just, how do I manage myself, not go the path of I need to learn more and more things as my account grows? Because I know the biggest traders and the best traders, they're not always trying to search for new information. They have an edge, they show up, they use the edge, and it's very, very boring. And maybe you guys won't realize that right now. Maybe it'll be further down the line. Maybe it's gonna be 3, 4, 5 years from now that you're gonna thank me and say, you know, trading actually is very boring. I'm showing up, I'm doing the same thing week in, week out. Yes, I get frustrated over losses, but I don't get frustrated enough where my drawdown gets out of control. You guys can see here that this drawdown never gets out of control, okay? Compare that with somebody that doesn't really know what they're doing and is not accepting of the risk. Their drawdown, you know, their equity curve looks wild. It's all over the place, right? That's them not accepting the risk. So what I want you guys to do is commit yourself to taking 25 to 100 trades using the fair value gap. Okay, you will find out what your hit rate is, what the profit factor is, you know, what your average win to loss should be. And if it's not in a great spot, you still have work to do with that one specific concept. Don't go to another concept and just all of a sudden, you know, abandon the fair value gap, because you're going to run into the same issues. You're going to pick up a new strategy. You're going to run through a back test. The results are going to be terrible. And you're going to think, you know, maybe trading doesn't work, but it's because you're abandoning the things that will work if you spend enough time with it, right? Dedicate yourself to understanding these concepts in and out. That's really where the edge is. So once you have the sample size, then it's just about being confident with those statistics, with the trades themselves, and then applying that in the live market. So I had my sample size proven, I was scaling up consistently, but then I hit a wall. I'd take back-tested setups to live markets and they'd fail 70% of the time. But that's because I was missing the most critical piece, and that is using the high time frames. Okay, the problem when you're only looking at the low time frames is that it leads you to over trading, then you're micromanaging and revenge trading. So I would be trading every single fair value gap that appeared on the 5-minute time frame, right? The biggest shift in my trading was when I focused on this. And everybody used to tell me when I was first coming up into trading to focus on the higher time frame. The higher time frame supersedes anything else that you see on the low time frame. And I didn't really understand it until I saw it in practice when I really started focusing on the high time frame, right? From weekly to daily to 4 hour to 1 hour. When you're looking at these time frames, each one of these will supersede the one before it. So a 4-hour level is more important than a 1-hour level. A daily level is more important than a 4-hour level. A weekly level is more important than a daily level. So if I see a weekly fair value gap, I'm much more inclined to pay attention to it than if I see one on the daily. And vice versa, if I see one on the daily, I'm much more inclined to pay attention to it than if I see one on the 4-hour. Vice versa, right? So if I see a bullish 4-hour fair value gap, but we're inside of a weekly bearish fair value gap, it's very difficult for me to take, okay? Because we're trading against that high time frame order flow. So again, if the weekly chart is bullish, I only take fair value gap buys. Why? Because it doesn't align. If I take a fair value gap sell, it doesn't align with that higher time frame. So if I'm expecting the next weekly or the next daily candle to trade higher, why would I be taking a short position? Okay. What you do as an amateur trader is that you're not prepared, or maybe you are prepared, then you show up the next day and then that plan goes out the window. You see a bearish fair value gap, you take it and it fails and you get stopped out. And you're like, why didn't that work? Well, you didn't follow the plan that you put in place the day before. Okay. that is all trading is I'm creating a plan, okay? I'm accepting that I might be wrong on the plan, but I'm still going to follow the plan regardless, right? If the weekly chart is bearish, I only take fair value gap sells. This is how I align myself with my plan week in, week out. And if I do the opposite of this, I'm breaking my rules. So if I sit down in front of the charts and I'm very, very bullish on the next week, but then a setup appears that looks bearish and I take it and it fails, I broke my rules, right? Let's say even if it works out, I still broke my rules. Long term, it's not consistent. I know if I continue doing that, I will become a losing trader. Okay, so this definitely helps with timing, and it helps with you understanding the entire narrative when it comes to higher time frame context. But knowing when to trade with institutional order flow is only half the battle. Okay, the final piece that took me from profitable to millionaire was something I learned from my darkest moment, and that it really is trade management. So the way that I like to scale into trades is very, very important in how I become a profitable trader, or how I really exponentially became a profitable trader instead of just like an average profitable trader. Okay, you're going from, you know, a point of break even, right? Maybe you're a little bit profitable, but how do you get to that parabolic state where you're breaking a world record payout like I did? It's really trade management and learning how to scale in and add to winners. So let's talk about how I actually use trade management. So let's just say, for example, my first position is going to be $100 of risk. If I'm able to move my stop to break even, that means that this $100 risk is no longer on the table. And I'm only moving to break even when the market creates a new fair value gap. Okay, very important. Position 2 is then $100. So if I get stopped out on both positions because this one is at break even, my total loss will only be $100. Now let's walk through this just from a visual standpoint, right? So let's say this is our first fair value gap and I go long here. And my stop loss, let's say, is down here. My entry's here. Let's say my take profit's all the way up here. Let's say the market moves away, but it doesn't quite get to my take profit. And then it comes down here and then it creates another fair value gap. Now I'm able to move this stop loss. Okay, so let's say that this stop loss goes to break even. Now I don't have any more risk on the table. You guys see what I'm talking about? This trade is now at break even. So if I get stopped out, I'm not losing any money. Now what's going to happen if I add another position? So let's say we get a trade down into this fair value gap and I'm able to add here and put my stop loss where my initial entry is. So I'll put my stop loss where my initial entry is. So I'll enter here, put my stop loss on that second position here, where my break even point is. And my take profit is still in the same area. So I have two take profits here now on both positions, the same level, right? What does that actually look like when it goes to my take profit? Well, let's walk through it. Okay, so here, let's just say we entered as this market is jumping higher. We have this fair value gap. I put my stop loss here. The market moves away aggressively, right? So after we entered, yes, there's a little bit of retracement, but it starts moving away aggressively. And then we get another fair value gap. Okay, so we have a new fair value gap and we're up about 2R, but it's not quite yet at our take profit. What I'm going to do is move this original stop loss to break even. And then I'm going to enter a new position here, right? With my stop loss. You guys can see where my stop loss is. It goes below the low of candle 2. So here's the fair value gap, right? There's a fair value gap. My stop loss will go below the low of that candle. Okay, so I could even move this stop loss, this original stop loss, into profit. So if I get stopped out, I'm actually making a little bit of money. Okay, and I won't take a full R loss. Now let's just roll through price action forward. Okay, it eventually goes to take profit. If we didn't add into the trade, we get 5R. But the fact that we were taking the same trade idea, the fact that we think it's going to go all the way up to this take profit, we add another position instead of you getting 5R, right? So let's say if we don't add, I'm going to, write this out. Let's say if we don't scale in, 5R. But if we do scale in, what does it do? It adds another 3.5R. So you're getting 5R plus 3.5R, which is what? 8.5R total if that trade goes to your take profit. Whereas if you don't do anything, it's just 5R. But if you get stopped out, you're only losing 1R, okay? So if you get stopped out, you're only going to lose 1R. Let's say if I risked $100 on the trade, I'm only going to lose $100. So if I risked $100 here on this first position, right? And it goes all the way to my take profit, I make $500 or I lose $100, right? But if I can move that first position to break even, right? I'm not going to lose that $100, even if it comes all the way back against me. You see how I scale in appropriately? It's essentially I have two trades on for the cost of one. I have one risk, one unit of risk on. I'm going to lose $100 total regardless of what happens. And that's very, very powerful. Instead of me making $500, now I'm making $850 without taking any more risk on. Because with this trade idea, I only wanted to risk $100 initially, which I did if I was able to move that stop loss to break even, because I'm taking risk off the table. So basically, when you take risk off the table, you can essentially say that, just pretend like that trade is not even running, right? right? And that this trade on its own is its own trade, right? You can isolate it and say, I'm only taking one trade here. This trade, whatever it does, because I don't have any skin in the game. I don't care if I get stopped out. I don't care if it goes to take profit, as long as you're not paying attention to the P&L. So really, this scaling strategy is what took me from making $50,000 a year to, millions, 7 figures a year in trading profits. So my biggest winning days weren't from just being right more often. They were from being right and having size with conviction. I know what you're probably thinking. This is simple, but what if I screw it up? Because I've been there too. And the reason is because it's not even about the strategy or the charts as much as it is about you staying disciplined and consistent. If you want to finally stop blowing accounts and become consistent, I created the Trading Apprentice, where I walk students through the live markets every single week. You'll get to trade live with me, have me review your trades, ask questions, and learn what it's like to trade like a 7-figure trader. I'll leave a link to that in the top of the description. But just keep in mind that I'm only looking to work with the most serious students. So there you have it. The exact ICT approach that took me from 10 years of losses to $4.5 million in profits. Fair value gaps for entries, kill zones for timing, and proper risk management to stay in the game long enough to succeed. Look, I wish I could go back and tell my younger self, the one who was stuck in a job he hated and kept blowing trading accounts, that there was a simple path forward. But since I can't do that, I'm sharing it with you instead. You now have everything you need to start trading ICT the right way. Thanks for watching, and I'll see you guys in the next video.